Your biggest risk, honestly, is not that the business would not do well. Your biggest risk is that the founder will get tired and say, you know what, I can't do it anymore, right? And then you can't do anything about it.
Hey everyone, this is Prashant and I'll be host for the VC 10X podcast. And today we have Ashish Kumar with us. Ashish is a co founder and general partner at the Fundamentum Partnership. Ashish began institutional investment as a partner at Fundamentum Fund 1, a Series B plus focused VC fund out of India. He later co-founded Fundamentum Investment Advisors alongside Nandan Nilekeni, the co-founder of Infosys, and Sanjeev Aggarwal, the founding CEO of IBM. In this episode, we talk about the founding story of Fundamentum, how to assess PMF in a company, the growth investing landscape in India, their portfolio success stories in the name of PharmEasy and Spinny, the exit landscape in India, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hi, Ashish. So good to have you on the VC10X podcast. How are you doing?
Thank you, Prashant. I'm doing very well. Pretty excited to be here, and I have seen some of your podcasts, so pretty excited about that.
Thank you so much. And I love what you're building at Fundamentum. So tell us what Fundamentum is and how you started it back in 2017 alongside visionary entrepreneurs of the country, Nandan Nilekeni and Sanjeev Aggarwal. So tell us about that story.
Yeah, so we started Prashant around 2017, right? And it wasn't really, typically venture funds start with having, let's say, a entity which will manage multiple funds over a period of time, right? And typically, all people, all employees are part of that, what we call as the asset management company, AMC, and this will launch kind of multiple funds. When Fundamentum was launched in 2017, it really wasn't necessarily uh, thought of as one that would necessarily launch multiple funds, right? The idea there was that there was a passion in people to have to invest in a what we call as Series B companies, early growth stage companies, and partner with some stellar entrepreneurs and build companies for the future, right? We thought that the country had seen a lot more sustainable companies and a lot more scaled companies, but we did not think that the entrepreneurial startup ecosystem, at least in the last 10, 15 years, had seen too many sustainable startup companies. So we thought it was an opportunity to kind of create that. So it all started 2017. Nandan was the really the brain behind it, right? Nandan and Sanjeev kind of came together initially, and I joined little later. It was the concept was kind of already there from a fund one perspective, right? So we did not, like I said, we did not have a formal structure on the asset management company even then. We only launched our asset management company around 2022, which is prior to the fund two, which is when we thought that now, hey, this is the institution that we want to build, because we had launched fund one, we had made some investment, we thought the thesis makes sense, there was a team that had gotten created, and that was the entity. This asset management company is what was co-founded by Nandan, Sanjeev and I, right? But the fund one specifically was really, if you were to call the co-founders, it was more Nandan and Sanjeev. My personal background was that I ran few companies. I have been always an entrepreneur, right? I was an angel investor and entrepreneur, never really a institutional investor prior to that, right? So I thought the idea of working with somebody like Nandan was the one which really drew me to VC investment. It wasn't, honestly, at that point of time, when I think about it, to be candid, wasn't important what that business was. It was very important for me to kind of work with somebody like Nandan. I've always kind of learned from people who have, who are done well in life, right? And you do learn, it's very contagious. Learning is very contagious. So that is how we started. So now we are, of course, formal structure, fund structure, and the second fund is currently in play.
Totally. And can you also tell us about how big was the first fund, and how has it played out till now?
Yeah, so the first one was slightly less than $100 million, the US $1 million, and it has played out beautifully, right? So when we started, if you look at Indian startup ecosystem, Prashant, truly, I think it started maybe 10, 12 years back, right? Although people, institutional investment started to happen in India as early as early 2000s, right? And I at least came back to India for after 3 years working with Microsoft in the US in 2004 and 2005 beginning, right? And but the it was a very, very small ecosystem for the first 6, 7, 8 years. Somewhere around 2010, 11 time frame is when the ecosystem kind of became very large, or started to become large, right? And then, of course, after that, internet became ubiquitous. Geo actually enabled the ecosystem even more because of the total data cost and so on and so forth, right? So we thought that the early stage investments, the early stage companies, we thought were reasonably well served, right? So it was easier for people. It had become easier for entrepreneurs to start companies, get them to a stage, iterate through the what we call as the product market fit journey, right? And get to a stage where that the company would know whether the product has any demand for that in the market, which is the what we call as the startup phase, right? The second phase is what we call as the scale up phase, and the third is, which is sustenance phase, right? So we thought the scale up phase, and this is 2017, Prashant, wasn't really as well understood. So we thought the design of the firm has to be, one is that we will start investing in companies which are in the scale up journey, which means that the companies probably will be around maybe 2, 3 years, maybe slightly more as well, depending on different kind of industries and different business models. And then partner with entrepreneurs who want to really build a business for the next 10, 15, 20 years. As funds, of course, you will exit sooner, but the idea there is to partner with those entrepreneurs and then build a very concentrated portfolio. The idea was not to really, if you look at typically venture funds, they invest in 30 to 40 companies, maybe 10% of them will do very well, 20, 30% will do, kind of so, and then maybe the last 50% will probably not even return the capital. That's the design of the kind of venture firms, right? Typically early stage venture firms. We thought, why don't we build a concentrated portfolio? And it was possible because we were investing in slightly early growth stage, which means that the initial product market fit risk has kind of gone away. And we said that if we can find a fewer companies, maybe 8 to 10 companies per fund, and then not only invest capital but also bring in little more company building skills, so perhaps there is we will be able to add little more value than what was available in the marketplace at that point of time. And that is where, when we put together the firm, we said that everyone in the investment team has to have built businesses in their prior lives, right? Or have be a very strong operator. So if you kind of notice, people in our fund, there is a very strong bias for people who are entrepreneurs and operators, and and equally probably important negative bias for probably people who are only investors, right? So that's how we ended up doing. The fund has done very well, and we and that was the reason when we actually started doing fund 2, there was significant demand. And even though the first fund was slightly less than $100 million, the second fund we raised was slightly less than $250 million.
Right, totally. And I think you've recently announced the fund two as well. And what will be the focus there? Do you think any changes in strategy there, or more or less the same focus as fund one?
Very similar, right? So, typically we ask our companies to kind of hit product market fit and then scale up, right? So we also think that funds also go through the same journey, right? So the fund one was really truly establishing a product market fit, and we are very thankful that some of our investors, many of our investors, actually kind of supported us in that journey, understanding what we wanted to kind of achieve, right? So we think that as a fund, we also have the product market fit. So there is no point in kind of changing that thesis, right? Naturally, you will, since the fund is larger, we our ability to go slightly more deeper into a company in terms of the more dollars per company, that is there, number one. And then we are also able to do a little more number of investments. So as an example, in the fund one, we only made six investments out of the hundred, out of the $100 odd million. And from this fund, we will likely invest maybe 10 to 11 companies. Very similar, just incrementally improving what we have been doing so far.
Absolutely, totally agree. And on the fact that the fund has achieved PMF because you're raising a second fund after a period of, I think, 6 7 years than the first fund, which is very uncharacteristic of VC firms. They typically, raise a new fund maybe in 2 3 years, and while there's not much of performance indicators there for how the fund one is doing, but like for what it is for Fundamentum, you have waited it out and seen how the fund is performing, and now you've raised fund too, right? So totally that approach there with the fund itself, right? And Ashish, what do you think, so is it a sector agnostic firm there?
Yeah, so we talk about two things. One is that so we are stage focused, generally sector agnostic, right? So India, Prashant, if you look at as a country, we are still maybe 10 15 year old startup kind of economy, venture economy, right? So typically, for any venture a country to attain a maturity from a venture economy perspective will probably take maybe 30 35 years or so, right? And this is when you will start seeing that there are very sector specific, stage specific funds and so on and so forth, right? If you look at all early stage funds when they started 10 years back, all of them were sector agnostic, doing early stage because that is what was kind of available from a supply perspective. So we are a stage focus, which means that we will only invest in companies where we think they have attained product market fit, which usually means that we are not the first institutional investor. There could be one odd exceptions, and particularly in today's time, because there are some very frugal entrepreneurs who come, who probably bootstrap the business and get to a stage, but they are in all honesty lot rarer in breed, right? So we typically come in when the companies has raised a little bit of capital, maybe 4 5 7 8 million dollars, less, definitely less than $10 million or so, right? They have gotten to a product market fit, and then technology has to be the meaningful driver for those businesses, right? So if you think that technology is the lever to scale those businesses, and they are operating in certain sectors where we think India will see those sectors to grow significantly faster, right? So if you look at, let's say, our gdp would grow, depending on what numbers do you look at, anywhere between, let's say, 6% to 8% or so, right? That is what they are kind of anticipating. But now naturally some sectors, and if you account for, let's say, inflation, the net growth is around 10 11% or so, right? Some sectors would grow faster than 10 11%, some sectors would grow at less than 10 11%. So you'll naturally look at some of the sectors which are kind of growing faster than the GDP, because then you get a direct benefit, which is typically consumption, which is typically healthcare, which are, let's say, some of the segments in the luxury segments, which are some of the content companies which are where the consumption is from, let's say, a tier 2 tier 3 country and so on and so forth, right? Similarly, there will be SaaS companies. So we are biased towards certain sectors, but we will typically look at multiple sectors with a very open mind.
Yes, totally. And talking about the growth stage investing in India, that ecosystem is still not very developed, while the early stage is still relatively more developed than growth stage. So, how do you think investing at growth stage, how many VC players are there in that space alongside you? And how easy or hard is it to get investment at that stage? Because we are seeing that a lot of uh, companies are struggling to raise their series B and series B plus round, especially in the current market, right? They have raised until series A, but now they get a major hurdle for crossing that series B stage mark. So what do you think they should be thinking about, and how they should be building in order to cross that hurdle?
No, you're absolutely right, Prashant. Right? That exactly was the thesis for us as well. That the growth stage investment, early growth, a little more specifically, uh, is underserved, and my sense is that it will continue to be underserved for the next few years at least, right? And there are a couple of reasons for it, right? One is that like I said, the ecosystem is probably 10-12 years old, right? We are just getting to a stage where we are probably maybe a few companies which have shown scale and sustainably, and so on and so forth, right? So that we are now finally at a stage where there's a critical mass of companies where somebody could kind of look at it, right? So in terms of the number of players, number of VC firms who look at this sector in a very focused manner, these are all single digit numbers, right? Probably four, five, six funds. That's all. There are funds who are kind of focused on that. Uh, at the same time, this what also happens is that there are two other types of players who kind of operate in this. One is that, let's say, early stage firms who have also become larger in terms of their total asset under management, right? And these are usually the overseas names that you kind of know about. So they also start operating into the growth stage, because what they would say that, hey, I've already invested in the early stage companies. Once they grow larger, I would also put in more money into those companies. So that's one area that they are also operating. But those companies usually, those firms will usually invest in their own companies rather than a company which could be competing with their company. So they have a challenge on, even if, let's say, their portfolio company may not be doing the best, and they know that some other company competing with their portfolio company may be better. It is difficult for them to invest just because of conflict reasons, right? The other funds who are what we call as the crossover funds, typically a hedge fund which will also invest in public markets and private markets and so on and so forth, right? Private equity kind of funds who typically invest in companies where they are very particular about, let's say, profitability and so on and so forth, right? Typically technology companies take a little longer to get to profitability, in just because they go for market share before they go for profitability. But those are some of the firms which are also participating. And anytime there is heat in the ecosystem, like what we saw in, let's say, 2021, early 2022, and so on and so forth, you will see a lot of these crossover funds, hedge funds, and private equity funds coming into technology, because they all want to kind of take a pie of it. But times like this, they typically take a back seat and go back to what their core is, right? So this is to kind of say that, if you're an entrepreneur building this up, like, you have to understand and establish that who are the people who are a lot more focused on this stage of investment, and look at them as a lead investor. The moment you identify a lead investor, you could still add, let's say, other people who may not necessarily be operating so much in a focused way in this particular area, this particular stage. But the moment there's a lead investor, they could say that, hey, why don't I put little more money to this entire round? So that's how people should think about it. The basics of the business, honestly, has remained the same probably last maybe 100 years, 200 years, and 1,000 years, right? So the idea there is that you have to serve the customer right. You have to have a right to win in a market, which means that you have to understand the value proposition offered by incumbents and the competition, and ask yourself a question that, why is your offering better than anybody else? And then you should be able to articulate that, right? And the third is that it should also be a very scalable model, right? Like, if a company is a small scale, very profitable, typically those companies may not necessarily make sense for a venture capital, because we have to put in a little bit more capital, right? So and for if I'm putting, let's say, $10 million in a company where the valuation is anywhere close to $100 million or so, if the company cannot get to at least a $500 million number, it won't not make sense, right? Most people will typically look at $1 billion enterprise valuation, and when you look at, for to attain an enterprise, $1 billion enterprise valuation, depending on what business model and what are your gross margin profile, the revenue could be anywhere between, let's say, $100 million in the case of a software as a service businesses to, let's say, a $500 million in the case of, let's say, a retail business with a smaller, maybe 15-20% kind of gross margin, and so on and so forth, right? So that is where it kind of straddles along, right? And that's what the founders have to be aware of.
Totally. And one important aspect of early growth investing is that you have to judge and evaluate that has this company achieved a product market fit or not, right? So what is a clear indication of product market fit, and how do you judge it?
So that's a great question. So, judging a PMF is a topic in itself, honestly, right? Is a full science in itself, and the answer also could change depending on the industry and a little bit of competitive intensity. But I'll tell you what is a true indication of product market fit. Very few people, by the way, are able to get to a true indication of product market fit in the early stage. So there will be some dilution, and that is where the judgment comes into play. But a true indication of product market fit is that you are growing market share as compared to the competition that you have at an economics which is improving. If you are able, and at a customer satisfaction score which is also continuing to be, improved, right? So if you are able to get to all three, that there is a, product market fit. Now it's a, of course, it's a lot to ask from any company, because it's very, very difficult to kind of get to that stage. And that is where you, depending on how the industry structure is, what is the competitive intensity, our job is to judge that where is the gap, right? And then figure out which ones can we live with and which ones are kind of must to have, right? And if you wait too long, I think the interesting part in our business, Prashant, is that if you wait too long, the pricing for that company will be very high, right? So you don't want to, you also have to be smart, right? So if you have everything right, the founder also knows it, right? So then the pricing will kind of reflect it. So the idea there is that, can you engage with the company for a long period of time before you make an investment, right? So that you track the number one, progress, right, over a period of time, which data would tell. But probably more important, track the thinking of an entrepreneur over a period of time. That may not necessarily reflect in current data, but it will reflect likely in future data. So if you're able to understand that sooner than anybody else, then you will say that, hey, let me actually come in when it may not be fully clear that everything is in place, but maybe 70% things are in play, 80% things are right, and so on and so forth. And that is how you make those investment decisions.
Right, totally. That's very insightful there. And what's this period of time that you're talking about? Is this after, once the founder has pitched you their company, do you start tracking them after that point, or are you already on the lookout that these are the founders on our radar and let's keep tracking how they're doing? How does that work?
So all great matching, I look at them as a dating problem, Prashant, right? So typically, um, you always, like anybody approaches you, lot of times it is a question whether it is the right thing or not. Anybody who you approach, basically, right, are the ones you get little more fascinated about, right? That's the typical way that kind of dating works, really, right? So if you look at, even in the case of funding, what we do is that we focus a lot on outbound, right? And the way we look at is that, since we are a more, let's say, series B investor, right? So the moment a company gets first institutional check, and we will start tracking that company after that, right? In a usual time, the gap between, let's say, a first investment and the second investment could be 18 months or so, right? In a more contracted time like 2021, that period could, you know probably become smaller to maybe even 6 months or so. But in a very bad time, that number could be even, let's say, 24 months and 30 months, right? But if you just take that median, let's say 12, 18 months or so, the idea there is that we have to meet them for almost 12 months, periodically, right? Some companies maybe 6 times, some company 8 times, some company 3 times, right? And uh, do and try to add value to those businesses, right? You will probably track maybe 100 companies very very closely, and you'll only invest in 3 companies. But I think great founders always have multiple options. So you have to keep adding value to those businesses. Either you try to kind of help them hire people or make some connections which could be helpful, and truly believe in karma, right? That and if you're dating well, I kind of tell people that proposal is just a formality, right? You kind of understand that if you're dating well, the idea is to kind of get married, right? Which is, in our world, it is an equivalent of a term sheet or a investment, that decision that kind of happens, right? But we do want to track those companies for a long period of time.
Totally. And let's talk about some of your portfolio successes, right? So there is Spinny, there is PharmEasy, right? So tell us how you judged the initial PMF in those companies. What was it looking at that time? And also, how's it playing out? And what's been maybe a common thread that you see in companies that worked out versus the ones that didn't?
Yeah, so both Spinny and Pharmacy, which are the two of the kind of largest success for us, right, so far, uh, were very different, right? So when we looked at Spinny, Prashant, there were like 5 or 6 players which were existing, like Car Dekho, Car Wale, Droom, Cars 24, and so on and so forth. And Spinny was, and this is 2019, if I remember correctly, right? So Spinny was actually a small company at that point of time, right? Because when we came in, it was less than $100 million enterprise valuation, close to I think $90 million or so, if I can remember it, right? And they, of course, they are close to 1.7, $1.8 billion as per their last round. Uh, with What we saw was that used car purchase and sell has a trust problem, right? In general, anybody you are buying a used car from, you by default think of that person as a crook, right? And that crook who's trying to fleece you, right? So it's not really a pricing problem, it as much as it is a trust problem. So if you could trust it, and especially as a buyer, because you will drive this car for the next 3 4 5 years, right? And your family will also be sitting, your kids will also be sitting. So it's a very important purchase, and a large purchase for a large number of kind of Indian population. So uh, we thought that in that a full stack model makes sense, which means that you have to buy the car, like refurbish it, and then kind of put that available as a sale, and then give the right guarantees, warranties, and the insurance, and so on and so forth, right? So think of them as not a used car purchase, to think of them as a, almost what we look at Spinny as OEM for used cars, rather than a used car transaction platform. The way I go and buy a, let's say, Maruti car, right? I effectively look at multiple options, then I talk to them. They will say that, I will not only get a car, but I'll get loans, I will get insurance, and I'll get warranties, and so on and so forth, right? This, if you could replicate the same thing in a used car, it is only possible when you're doing a full stack model. Not any platform at that point, there are only two platforms. Spinny was one, and there was another very close competition called Truebill, which Spinny ultimately ended up acquiring. They were the only two platforms which were kind of building this out, and our thesis was that ultimately, because of the higher customer satisfaction score associated with, full stack buy, Spinny would end up winning, right? So that was a bet that we took in a company which was significantly smaller in a size, in a reasonably competitive market, right? And that is something that we were thinking about. PharmEasy, on the other hand, was a different market, because there were 5 players again there, but all of them reasonably neck to neck. Maybe there was a 10 to 20% difference, right? So it wasn't that the market leadership was established. So we looked at, so every sector, that every company that we look at, we kind of look at a triangle of three capabilities. One is technology understanding, second is business understanding, and the third is domain understanding. Now, depending on what that industry is, we focus on entrepreneurs understanding of one of the three pillars higher than, let's say, the other pillar. So as an example, if you look at e-commerce, right? Technology now with where e-commerce is that it is easier to hire a talent who has created and built e-commerce businesses thanks to Flipkarts of the world, right? They actually showed it, let's say 10 years back, 12 years back, and so on and so forth, right? So we knew that technology is important, but we can hire those people. What we understood was that domain was a far more important understanding, because this domain, there is this industry structure is such that there is some dynamics at play which ensures that it is not a truly free market. There are some elements at play so unless you understand that domain, it's very difficult for you to build a business out of it, right? So when we looked at all of the players, we thought that business understanding anyways is required, right? Because ultimately you have to kind of create a dhanda, you have to create a business, right? So it has to kind of make sense. But we said, looked at 5 6 players, and we said that this company is better in technology, this company is better in product, this company is better in domain. So, and ended up choosing PharmEasy as the business. And then we said that since they're all neck to neck, it is very important for them to establish market leadership in the next 12 months, because the way it happens in technology investment, anybody who takes lead, right, typically get larger market share, or get larger capital, which is also a driving force for larger market share, and so on, so on, so on, so forth, over a period of time. So PharmEasy effectively did an IPL campaign the year when we kind of within 6 8 months of when our first investment, and PharmEasy took lead, and in the next 12 months they were almost 3 times larger than any other player, and which is why they kept on kind of getting more and more money, right? So the point I'm trying to make is those are two different, those both successes, but very different execution. But what was common was maybe couple of things, right? One is that very first principle and committed entrepreneurs. If you look at typically companies that people like us would end up investing in, they are disrupting some industry here or there, right? Which means by definition they will have fewer parallels, right? So you will probably find some examples in different countries, but the business model, the execution model in India is very different from how it is in any other country. So you have to understand that the founders have to be very first principle committed for a long period of time, number one. And number two is that they have to be great at managing stakeholders, right? And their stakeholders could be shareholders, stakeholders could be different business participant, and so on and so forth, right? So it's very important that the founder has to be very inclusive, because India again, we see great successes of like people like, let's say, Elon Musk in the US, right? But if you look at most people who are very successful in India, they're not as flamboyant, right? Whereas US, like, could be a lot more flamboyance, but it values flamboyance. The industry, the market is like that. So flamboyance is important, for certain stages, but in general you have to be a lot more inclusive. So that's the another area, that's another thing that we also think about when we look at any entrepreneur. And naturally the market has to be growing, and so on and so forth. That's actually obvious, but I thought I'll add something which probably gets talked about slightly less.
Yes, totally. And you mentioned about an IPL campaign that PharmEasy ran and then eventually ended up tripling the business. Was it because of the IPL campaign?
So it definitely was a large factor, right? So if you look at, as an example, e-pharmacy, whether you buy from PharmEasy or you buy from, let's say, any other brand, the end product, right, is still the
Right.
same medicine, right? So what
Correct.
you
Correct.
value is two things, right? One is the customer experience, and the second one is whether you have heard about them enough or not, right? Reach, which is because people kind of almost associate brand or brand awareness with comfort and with quality. That is what people typically associate with, unless you prove it otherwise, right? You could still do all of that and then prove it otherwise as well, right? So, and those were the two things that we looked at. So as an example, another thing that was very striking about PharmEasy was that they many of the other players actually were working only with third party logistic players like deliveries and the three like, and the other 3PL logistics players, which means that the moment you order, what would happen is that when you get medicines, it will probably from a delivery or some other third party logistics provider, which is a little bit of a challenge in certain medicines, which typically, let's say, have to store. have to be carried in a cold storage. Let's say you are ordering insulin injection, right? So that has to be carried. So that supply chain from a logistic perspective was not fully there back then. Whereas PharmEasy, I had an army of, in certain cities, the larger cities, they actually had their own fleet, which we thought was very important for their customer satisfaction score to be superior than anybody else, right? So we thought that this is where compounding of good customer experience will start happening. So that was one. And then IPL, absolutely, because it kind of, when there were like noise, you will say that, hey, this is something I heard now, let me try it out, right? And once you try it, since it is a prescription medicine, you upload your prescription there. Now if you are happy with it, you will not switch and go to some other player, because if you go to some other player, you'll again have to upload prescription, right? So it is a little bit of a land grabbing industry, just because of the nature of what the product is, right? And this was also the reason why we thought it would be a little more difficult for somebody like an Amazon to do it, because for Amazon, it's not like adding a electronics or a book which could just be ordered like this, right? There is a service layer, which means that you have to upload prescriptions. That prescription has to make sense, and so on and so forth, right? So yeah.
Yes, totally. Some great insights there. And let's talk about the exit landscape because you're investing at growth stage. So I think you're expecting an exit in 5 to 7 years time frame. Is that correct? Right?
Yeah, so the funds are our fund is again like 10-year fund. So typically,
Okay.
anywhere starting from fifth year to eighth year after investment, depending on when we
Right.
have invested, is what we look at, right? So if you look at funds, usually of a 10-year, 4 to 5 year is investment cycle, and then
Right.
the last 5 to 6 years is when you kind of start basically exiting, right? So if you are invested very early on, you have little more
Right.
time. You could exit after 8 years, but you have invested in the fourth year, you have probably little time, right? So the point is that after the investment, you start looking at exit between anywhere between fifth and the eighth year of the first investment in that company.
Got it.
On the exit environment, I think as a country, we have come a long way, Prashant, right? I think if you had
Right.
asked me this question 5 years back, I probably wouldn't have had any option other than to kind of smile at it and kind of maybe try to sidestep this question, right? Now, I think there are two things, and I'm not saying the problem is fully solved. I think that we still, as an ecosystem, have to solve this problem. But I think there are couple of ways it has improved significantly. One is that the IPO markets have opened up, right? And then IPOs have some IPOs have done well, some IPOs have not done well as well, right? So people also know what, when you have to IPO, what is required to be done, right? So it also, there has been a learning there, but nevertheless now it is an option, and I do anticipate next 10 years you will see a lot of technology IPOs that would happen in the country, and not necessarily at $1 billion, right? So if you, right, this could start happening at, let's say, 400, 300, $500 million, and this is when retail investors would come in, and they could also kind of make that money, right? This is exactly what happened in the US, right? Microsoft was never it did not start with a $3 trillion company. It started, my first job was Microsoft. I kind of remember, even then it was a probably 200 odd $1 million company, and I'm sure prior to that it started with a few billion dollars, and so on. So Nvidia, which is a 2 trillion, I remember, when I first started to work, Nvidia was listed, it was probably $3 to $4 billion company, and so on and so forth, right? An equivalent number for India would be lower, right? So those IPOs would happen. The second that will happen is that the moment there are more technology companies which are public in the market, they would start acquiring some of the companies as well, right? So I actually think that M&As beyond, let's say, $500 million or so will not be as common in India next 5 years or so. So companies will have to IPO, but these will start becoming a lot more common, let's say fifth year, sixth year kind of onward, because by that time you will have more number of technology companies which have IPO.
Totally, some great perspective there. And uh, we have seen some interesting stories play out in the Indian startup ecosystem. One of them, of course, being Paytm, another one being Byju's, right? So, what do you think maybe went wrong with how they were building, and what can be the lessons that can be derived for founders building today?
Yeah, so I think both have very different reasons from what I understand, Prashant, right? And I am we are not a shareholder in either of the two companies, so we are of course not fully privy to what has kind of happened, right? And my knowledge is a lot more also based on some of the industry conversations and the what probably you and I both read the newspapers, right? So, but I think the problems are very different. While Paytm had a question more about kind of regulation, Byju's had a problem apparently about governance and some of the conflicts between, let's say, the founder and the investor group, right? I think two things have been very clear in our country. Number one is that you should not play with the regulation. You have to be fully abiding by the regulation, right? Some of us, and me included, actually thought that there could be regulatory arbitrage in the country, at least in the technology world. Because if you look at some of the very interesting global successes like Uber's and the Airbnbs, they did have some regulatory arbitrage, right? Uber was not, let's say, fully legal in many countries, and they could, but they kept on pushing through it, and they ultimately got kind of regulatory clearance in at least many countries, and so on and so forth. I don't think that India will tolerate that as much, right? So that's number one lesson that I think there is. The second lesson is, and this is honestly, this shouldn't have happened, but governance has to be top notch, right? One of the reason why technology companies are also valued higher than other companies, because it is understood that you are, hey, most founders are, let's say, from the good colleges and so on and so forth, right? It is assumed that the governance is high quality, right? And if you look at typically India, one of the challenges that a lot of investors tell me is that the governance, even in a lot of listed companies in India, not necessarily are the best, right? Which is why some companies get traded very high, because it is understood that the governance are very high, right? So and that is those are some of the problems we have seen in the ecosystem, at least in the last couple of years. So I think governance is the other problem that we have to deal with it very sharply. And the third is that, again, we are a smaller economy. We are a large economy in general, in terms of that we are the fifth largest economy, likely becoming third largest economy sooner. But our GDP per capita is still lower, right? Which means that our companies, particularly on the consumer side, will take will longer time to get to profitability, because you have lesser money available per transaction and so on and so forth, right? And so, which is why growth at all cost, not thinking about profitability for a very long period of time, will probably have fewer takers. So we will have to kind of balance that sooner than later, right? So US, again, in the more developed market, you could probably say that, hey, I can choose to continue to grow market share before I think about profitability for maybe 5 years, 7 years, 8 years, maybe more, right? In India, I think you'll have to probably do a lot sooner, because that's the nature of the market. US, you could also list company which are not necessarily profit making, and in most time they would still work, right? In India, we know that the appetite is kind of not there, right? And so we have to be aware of it, and that is how those businesses have to be built.
Totally. And coming to my last main question before we move to the rapid fire round, and this one is, what has been your biggest learning investing in startups over the years?
Oh, many. The biggest one is, it's a patience game, right, Prashant? I think you have to make high conviction bets, and then be patient for a very long period of time, because the companies will go through ups and downs. There's data that, right, in every India, it probably takes 10 or 12 years before a company becomes sustainable. And before that happens, there are at least 2 to 3 near death instances that happen for a company, right? So you can't basically say that, hey, you know what, I had conviction today, and 2 years later, I don't have conviction anymore. And now the more, because of the macro factors, right? If there are, of course, issues internal, then it's a different thing. But I think you have to be patient, because companies go through times when they know about everything about what they need to do. Founders know everything, and there are also times when they're confused. That's where the founder and the investor relation is kind of very important, right? I almost think that you have to be have very high empathy for those founders, because honestly, creating and starting and running a company is a very lonely job, right? And not too many people can appreciate it. So you as a investor have to kind of understand it, and your biggest risk honestly is not that the business would not do well. Your biggest risk is that the founder will get tired and say, you know what, I can't do it anymore, right? And then you can't do anything about it, right? So that's, I think, that's the biggest learning for me.
Totally, totally. All right. Now let's do the rapid fire round wherein I'll ask you five quick questions about the fund and you have to give five quick answers, right? So, first one is what are the sectors and regions you invest in?
um, Fintech, AI led kind of services, which is, which was initially used to be SaaS, but of course AI led services, consumer internet targeting maybe the top 3 4 sectors. When I say top 3 4, these are like larger healthcare, logistics, travel, and the likes.
Great. What's the typical stage of investment?
What we call a series B, right, which is basically the right way to think about this is that post product market fit. Most cases it is series B, but sometimes it could be series A, sometimes it could be series C, sometimes series D as well.
Got it. What's the typical check size you put in?
$10 million is what we typically start with.
Great. Where can founders apply for funding in case there's a direct way?
Yeah, so the best way to always reach is to look at the people in the fund and reach out to them directly. That's the best way to do it, and that does not mean that you only have to reach to the partners, right? You should be, you can reach anybody else in the fund as well. Everyone in the fund actually maintains some kind of social profile, on one of the professional networks. They talk about certain things. So you should, the founder should figure out what is that somebody is talking about more, because the chances of them being interested in that is kind of higher. They could always write to us, through the website and all, and we have somebody who looks at it. But I think the better is always to kind of reach out directly to one of the team members.
Absolutely. I'll make sure to put all the links in the show notes below. Thanks so much for making time for this, Ashish. It's been a very insightful conversation. Thank you so much.
Thanks, Prashant. It was fun. I had a great time having this conversation.
Thank you so much.